Okay, gold stock data ratings. So these are the ratings, my upside and downside. So I've never I never did a video and explained these before. So and I have this is going to be useful too. I'm showing you how the ratings, how they fit in. But let me show you this first. So we have the one is the lowest rating, right? So the lowest rating, it just means, that's the worst, right? It just means um, it's bad. Anything that's a one is really, really bad. And then it gets progressively better. So 1.5, um, one basically means avoid at all costs, anything that's a one. 1.5, you can have majors can be 1.5s, potential two bagger. I'm not going to have a major as a one. The worst rating for a major is going to be a 1.5, potential two bagger. And a two bagger doesn't mean that it doubles in value. A two bagger means it went up 200%. One bagger is 100%. So this means it's going to go up three times, 3x. Two bagger again, 200% return. And then we have a two, which is a potential three bagger. And then we have 2.5, a likely three bagger. And these are all producers, not necessarily producers. I take that back. Can't say that because I use the same ratings for. Um, I'm going to talk about that on the next chart. The reason why I have them yellow, green, and red, depending on the upside and downside. So this is a likely three bagger, 2.5, potential five bagger, likely five bagger, potential 10 bagger. Now, this is as high as I go. I haven't used the 4, 5, and the fives yet. I might in the future. It's possible, but right now, um, I haven't used anything. Um, so if you see something that says potential 10 bagger, that means potential 10 plus bagger. This really should be a plus, and these should be pluses on potential fives. Um, and even they don't have pluses, but they definitely could, because I don't have anything from 6 to 9, right? There's nothing from 6 to 9. That means that these guys could definitely potentially be in there in that category, and I don't have anything greater than 10. So that could definitely, these could be 10 plus, right? So that's your upside. The upside is just your upside potential on your market cap growth. Downside potential. So the downside is going to be the risk reward. And this is a combination of all the factors that go into like the quality of the company. It's kind of your risk reward on a risk basis. So your downside is really talking about risk, but it's also including reward as well as part of that, this downside rating. It's a two-factor rating, and I felt that there's no way you can encapsulate risk inside of this. So I split it apart. And so a one is something you avoid at all costs. I mentioned that before. 1.5, the only time 1.5 really comes into play is if you have a four. So if you have something that's a four, then very poor risk, but you still might analyze it. You're probably going to avoid it, but you might take a look at it, because this 1.5 could turn into a two, but that's the only time, right? Three, anything below this 1.5, forget about it, right? And then we have two, poor risk reward. And the two, the only time you're really going to look at two is again the four. It's the only time you're going to look at two. Otherwise, it's not worth it. All of these are not worth a two. So the 2.5 really comes into play with just about everything except for the 1.5s. The 1.525s become really marginal. You really want the 1.53s, and then the 3.5, and this is all, very poor risk. And again, when I'm looking at the risk factors, I'm putting in. So you could have I'm trying to include the reward as well. It's like it's it's part of that downside rating. It's not just a risk number per se. So for instance, like right here, when I have three and I say good risk, good reward, what I mean by that is all the factors like the management, Um, it's like it's the grade, the properties, the upside potential. That's just what it's going to do. But I'm looking at all these things, the location, and I'm looking at everything. So the location you can think in terms even the properties themselves and the uh, the additional properties, the exploration potential, all of that kind of can go into um, what I think it's going to do. I mean, the quality is what I'm trying to get at here. Is these do include risk. The risk reward is like it's part of the risk, but it's also like part of the quality. For instance, when I say tremendous risk reward, I'm really talking about kind of the quality of everything, the quality of the management team, the quality of the deposit, the quality of the location, the quality of the upside potential, how the value it is. So we're looking at that. Those all kind of come into play here. Okay, so we have, I think, like 3 slides left, but it won't take much longer to finish this up. So here we have producers. So we have a chart, um, and we have, this is the upside rating, and then this is the downside rating. So on a producer, we only really want, these are the stocks that we want to invest in. So we have a 1.5, but it has a 3 or higher in the downside. That could be a good investment. You're talking about it could lower, you're not going to get great upside, but I still have it as green because it can diversify your portfolio. And then a 2 and a 3 can also um, a 3 bagger, the upside's a 3 bagger. This is, only a 1 to a 2 bagger. Might not be fantastic, but can diversify. And then year 2, a 2 and a 3. I mean, it's going to be a 3 bagger, but yeah, but it looks really good. And then once you get to 2.5, of course, and then I have, these two, I don't have anything, right? We're going to avoid these. And then if you have a 2 and a 2.5, that's yellow. So you have to kind of analyze it. Is it worth it? Maybe, maybe not. So anything in yellow needs to be analyzed. That's why I have a 4 and a 2. These are, you might want to analyze this. So these are the ones that are, marginal. And these are kind of the best. And these are the avoids, right? Poor. So we have the developer, and you can see they changed a little bit. So on the developers, I only have 3 that are green, right? 3, 3, 325, 352, or 33, 353, and 4. These are the upside and these are the downside. Those are your greens. These can all be analyzed. And then we have exploration. And I actually have 3 or higher. So these are all ignores. So this is your color coded, gives you an idea of how to use the upside downside um, ratings to get an idea of red, yellow, green. Okay. Ratings. Uh, Category. Okay, so this is the matrix that I just had, this guy here, using risk analysis. So what is the risk analysis? So in addition to your upside downside, you also have a risk level. And the risk level is medium, high, or extreme. I don't use low anymore because there really isn't anything or I use moderate. There's no such thing as a low risk mining stock anymore. So I only use moderate, high, and extreme. So how does that come into play? Basically, you want to stay away from those in red, right? Be and very careful with those in yellow, and spend most of your time analyzing those in green. Anything in yellow will be better if the company's risk level is moderate instead of high. So if the companies that are in those yellows, if I go back, so anything in yellow, let's say the risk level is moderate, and the risk level on these stocks can be moderate or high. So you need to look at that. And so that's where the risk level comes in. That's why the downside is, again, a risk reward, not just risk. And then I have an additional risk level, moderate, high. So anything that's in yellow, if it's yellow and high risk, then that makes it tougher to invest in. But if it's yellow and moderate, then it looks a little bit better. So if the downside is a 3, which is good, and the risk is moderate, you can surmise that the risk level is lower on the lower end of the moderate spectrum. So what I mean is that I'm using moderate as my lowest risk, but that moderate spectrum is wide, right? You can have really good moderate risk or really bad moderate risk. And same with high. High can be really bad high or really good high. Well, it's kind of hard to have really good high, but you know what I mean. When I'm only using moderate, high, and extreme risk for each company, but there's a spectrum for each one. You can have on the left side, and this spectrum you have to figure out for yourself really. The risk can be, okay, this company, two companies can have high risk, but they're different, right? It's not extreme, but they're both high. They have different levels of high risk. One is kind of this end of the high spectrum, and the other one is at this end. One company can be very close to moderate but not quite there. You know what I mean. So you need to take that into consideration. Basically, my point is this, is that these right here, these yellow ones, you don't really have to be too concerned when you have the green, but anything that's in yellow, you want to look and see, is it high, moderate, or extreme? There probably isn't too many that are extreme, but high and moderates.